Thanks for coming here to watch these important videos that are going to increase your education and knowledge. I'm really excited about getting started on giving you all of these teachings on how you can beat the banks. But first, if you want to work with our award-winning brokerage, you can leave your information below and we'll be in contact. Now, let's get started. Let's go and beat those banks. So here we are on lesson number 1 where we're talking about how the banks profit from mortgages. So in very simple terms, the banks have depositors and they're putting money into the bank and they get an interest return. So they're getting a little bit of interest in terms of the money that they put into the bank. In addition to that, we've got the Reserve Bank and also we've got the money markets, whether they be in Australia or offshore, the bond markets and so forth. And they're what's called term funded facilities. Now those term funded facilities are again where the federal institution, all these money markets are lending banks or lenders that money, and they're also looking for a return on that money. So they're receiving interest on the money that they're lending. Now, how do the banks actually make their money? It's really simple. What we're doing, and we'll just illustrate this, is they're taking money at this price point and they're on lending that money at this price point. So what we've got in here is what's referred to as the net interest margin, okay? And that net interest margin is their profit, what they're actually profiting from in terms of that deal. So that is how the banks make their money. They're obviously lending it on to us as borrowers, and obviously we make those loan repayments and those interest repayments as well. So the banks have this opportunity to lend this money out, and it's the differential of those two things. Finally, as I come over here, the other way in which they can make their money, because obviously there's lots of competition in the marketplace, is that they can grow the size of their loan book. So if we're thinking about here as a loan book, what we're actually saying here is they can increase the size of the pie of that loan book by lending more money. So that might be a volume play down here. This is obviously a margin play, what we're talking about here. So lesson number 1 is we do need to understand from a foundation point of view that the banks and the lenders are lending money to you as part of profit-making activities that they're doing, and they'll return those profits back to their shareholders. If it's credit unions or building societies, they'll return those profits back to their members in other services and facilities as well. But ultimately, that's how the game is worked. You see the deposits coming in, you see other potential funding coming in, they work out what that cost of money is in regards to how they can on-lend that. And this is on variable side with fixed rates. They're obviously looking at, again, the bond markets and buying term facilities around that. They work out their margin. They then need to sell that on, okay? And that's how they make that profit difference between the two, or as I was saying before, about how they build that loan book in building that size. So lesson number 1, banks are in the business to make profits. This is how they do it. Now it's our job to start to work out how we can beat the banks at this game.